Hello, this is Brian Rezny, President of Rezny Wealth Management and host of the Rezny Wealth Report. We're here every Sunday morning. Of course, if you have any investment questions or concerns, send them to Brian Rezny at ReznyWealth.com, and we'll make sure we get your questions answered. You can also go to our website, ReznyWealth.com, and sign up for a consultation. One of the things that I find often with pre-retirees and retirees, they have many investment and retirement concerns. Concerns about the advice they're getting from their conflicted Wall Street firm, the advice they're getting from the salesperson or the annuity salesperson that's really just interested in selling you a product. If you're concerned about the advice you're getting, if the advice you're getting is not working, and you want that second opinion, you want your questions answered, call my firm. Numbers at the bottom of the screen. Schedule a consultation either at our Naples office or Fort Myers. Don't go it alone. Do not put up with bad investment advice or Wall Street conflicts or the annuity salesperson conflicts. Do what's right for your money. If you've got any doubts, you need that second opinion. Call my firm. There's a big difference. You know, today I want to talk about the markets a little bit, the economy, and really about what you should be doing with your money in order to protect it. A lot of the things that I will talk about today are around investor concerns and misinformation and blatant lies often from Wall Street and annuity salespeople. Investment strategy, what is yours? Let's talk about this just a little bit. What is your investment strategy? Do you actually have one? I can tell you if you're working with Wall Street or annuity people, you probably don't have any investment strategy at all. Because most of these Wall Street firms and annuity people, really what they do is they sell investment product. And once they sell you, they're often inferior products that are high in cost and commission, you are sent to the back of the line and your investment and retirement needs are not met. You need to be careful and make sure, do you really have an investment strategy? And does it include risk management? Emotional investment decisions hurt your investment returns. You know, we've seen a number of days of volatility in 2015 and of course in 2016 in addition. And one of the things that happens to too often to too many investors is emotion. You listen to a lot of these different shows and the world's coming to an end and China's going out of business and there's ISIS and this and that. Bottom line is this, your investment strategy needs to cover risk management, not emotions. Your emotional decisions, whether you should be buying or selling or getting hysterical because the market dropped 3 or 4%, is not an investment strategy. I can tell you, I've talked to thousands of investors over my 30 years of managing money, and I can tell you, the way that you lose more money and the way that you make less money is relying on your emotions or getting emotional about your investments. All investments will have volatility. It's how you handle that volatility that's going to matter. Maybe you should reduce some risk in your portfolio and have a less volatile portfolio, but you will never, ever completely get rid of any short-term volatility. It's a nature of the investment cycles, whether you're in bonds or stocks or anything in the middle. All investments, generally speaking, have some bout of volatility year by year. Asset allocation, the failed pie. I can tell you, again, managing money for almost 30 years, I see a lot of new customers come into our office that have what you see right there in front of you, which is the asset allocation failed pie. You know, you open your brokerage statement, your broker tells you, oh, we've got you all diversified, you're spread all over the place, you own 20, 30, 40 different mutual funds or ETFs, and basically good stuff's being dragged down by bad stuff and you're not making any money. Asset allocation to me is a failed, flawed approach, really pushed by Wall Street, only interested in gathering a fee on your money. Sometimes there's assets you don't want to own in your portfolio, and sometimes there's assets you want to own more of. Relative strength investing versus relative weakness. You want to own relatively stronger asset categories, but don't own everything because there's times in a portfolio where certain investments just do not make sense, and owning those for 3, 5, and 10 years and dragging down your portfolio returns is a recipe for mediocre returns and basically an unsecure retirement. thinking your broker is managing your money. This is another major issue a lot of investors have. I get calls all the time on my TV and my radio show, and people will say, my broker never called me. Because if you have a brokerage account, which I can tell you the vast majority of my TV and radio listeners probably have a brokerage account at a bank or an insurance company or at a Wall Street firm. A brokerage account is not managed money. You are ultimately on your own to make your own decisions. All that advisor or broker is really doing is selling you investments he or she is required to sell. Not the best investments, not the cheapest, but investments that line his or her pocket more often than yours. Your broker doesn't manage your money. Your broker or advisor in a brokerage account is a salesman, and that's it. Don't expect any real advice, even though they call you once a quarter with the relationship phone call to talk about the grandkids or kids. That's not money management. Don't kid yourself. Annuities will steal 30 to 40% of your retirement income. You heard it here, folks. If you're sold an annuity, plan on giving up 30 to 40% of your retirement income. Why is that? Incredibly high fees. Don't let any of these annuity salespeople tell you, hey, there's a free lunch. There's no free lunch, and you're going to give up lunch, dinner, and any dessert you have when you're sold an annuity. Variable annuities and equity index annuities are hybrid annuities, often sold on blatant lies and deceptive sales tactics. You got that right. You heard it here first. You want the truth? Annuities are dangerous to your wealth and retirement because the fees are incredible. Not to mention they insanely lock up your money, and they basically give you high, long end surrender penalties to get all of your money. With that said, you basically are going to be in the danger zone with annuities. One of the most expensive and highly complex of all investments. Most complex and almost the highest cost of almost any investment. Those costs come against your return. Insane surrender penalties. I've seen surrender penalties as long as 22 years at 22% to get all of your money. That's insane. There's no 10% free money, no free bonuses with annuity. There's a cost to get that bonus. Don't let the annuity salesperson blatantly lie to you. Read the fine print. There's no 8% returns with annuity either. Again, another blatant lie by the annuity salesperson. Average yearly internal cost structure, I find on a lot of these annuities, run between 3.5% and 4.5% a year. You can build a low-cost ETF portfolio at a fraction of that. That puts more of your hard-earned dollars in your pocket and not in the annuity salesperson pocket. You want to look out for you. Don't fall prey to these fake advisors who just want to sell you an expensive variable annuity or equity index annuity. These things are toxic. And not to mention, they tell you get tax savings, another blatant lie. You pay higher taxes than you were led to believe. Because when you take the money out of an annuity, guess what, folks? It's ordinary income, not capital gains treatment. Again, watch out for annuities. Dangers ahead with annuities. You have to read the fine print. If somebody sold you an annuity or is trying to sell you an annuity, it's a salesman working under suitability. Do this. Go to ReznyWealth.com. Download for free Why Annuities Are Dangerous to Your Wealth and Retirement. Read the free report at my website. Learn the facts. Don't fall prey to a free steak dinner or a slick talking salesman. Your retirement depends on it. I'm going to take a short break. I'll be right back with your questions after this. Hello, this is Brian Rezny. If your goals are to increase your retirement income and retire without stress, go to my website and download our groundbreaking free report. This free report covers the investment and retirement pitfalls that are often overlooked even by the smartest investor. If you're concerned about outliving your money during retirement, or maybe you want to make sure you're not leaving money on the table, this free report is for you. Know the facts. Your retirement depends on it. Go to my website, ReznyWealth.com, and download your free report right now. Hello, it's Brian Rezny. We're back. Of course, we're going to be taking your questions. If you want to send me a question, send it to brianrezny@reznywealth.com. Also, visit our website. We've got some great information on our website, and I know we've received a lot of calls and questions about any of our free reports. If you go to my website, all the reports are free. You can learn how to avoid outliving your money during retirement, why annuities are dangerous to your wealth and retirement, and my #1 downloaded report, Fiduciary versus Suitability, how to avoid bad investment advice. It's a must-read for any smart investor who doesn't want to be taken to the proverbial woodshed with your retirement account. Go to ReznyWealth.com. And as always, if you're concerned about the advice you're getting, if you have concerns about investments or retirement questions, call my firm. Schedule a consultation. You've heard me for years on the radio and on my TV show. Call us. Schedule a consultation. Get that second opinion. We do deal with larger investors, I will tell you that, but call my firm. Schedule a consultation. The number's at the bottom of the screen. Do it right now. Make sure you're making the right decisions for your portfolio and for the security of your retirement. Sam from Fort Myers, Florida. Will this aging bull market finally end in 2016? Sam, great question. I would say probably not. We've seen some volatility as of late, and one of the things as a firm that we look at very closely is risk management. That doesn't mean that we want to, or we can avoid every little bump in the road. Nobody can. You're going to get that if you're trying to grow your portfolio and grow your retirement income. You're going to get bounces in the road. You have to accept that. What you want to avoid is recessions, like what we had in 2008 or in 2000. We've had about 11 recessions in the last 60 years, by the way, and statistically we have a recession about every 6 to 7 years. Sometimes they're further apart and sometimes they're closer together. So what I will tell you is this: if I look at how we manage money and I look at recessionary indicators, that's the big key. If we start to fall into a recession where the U.S. economy is really slowing down. Not all the hoopla from Wall Street about, oh, this is going on or whatever to sell you the next fund of the day, but real recessionary things. Things like the GDP of this economy or our economy is going negative. We're currently not seeing that, but that would be a big warning sign. You're seeing unemployment numbers going up, meaning people are getting laid off in mass numbers, and unemployment's going from 5.6% up to 5.8%, 6%, 7%. When you start to see unemployment going up, again, another warning sign. Generally speaking, the U.S. economy looks pretty good. We've got slow growth, maybe 2 to 2.5% for 2016. And remember, recessions can happen. We look at this stuff closely, and if things change, we will definitely try to alert all of our TV and radio listeners. Of course, if you become a client of our firm, we can help properly manage your money. Give us a call. We'd love to sit down with you, Sam, and talk about your investment needs. Joe from Miami, Florida. Will gold's positive momentum stick? Joe, I'm not sure what you're talking about, gold's positive momentum, because if I look at the last 3 years, gold's been down, down, down for 3 years straight. In fact, last year in 2015, it dropped another 10%. So what I would tell you is this: gold has no real positive momentum. Typically, the reasons for gold going up or having the opportunity to go up is high inflation, which we clearly do not have. Geopolitical events could also add to that fuel on the fire, and we've got a lot of geopolitical events, which we always seem to, but gold is still in a very negative downtrend, relatively weak. So think about this. Because gold is weak and it's relatively weak and going down in the downtrend, the trend is your friend. I would not buy gold. If I own gold, I would sell it and take a tax loss and move on. Gold is tarnished. It's not to be owned in a portfolio unless we really get into some crazy war, which I don't see, and unless we go into a crazy, really bad recession like 2008, which again, I do not see currently. I would not own gold. Ultimately, gold could go a lot lower than it's already gone. Brett from Fort Myers, Florida. Will 2016 be like 2000 or 2008? Brett, you're talking about the recessions we had in 2000, 2008. I get a lot of investment research at my firm on a daily basis. I read a lot of different information about recessions and market valuations, the growth of our economy and the growth of the world economy, all these different metrics. I will tell you that unless, you have really high valuations in the equity market, which we're not seeing, a real slowdown in the U.S. economy, which we are not seeing, housing prices that are crazily overpriced like you did in 2008, which again, we are not seeing. I don't expect 2016 to be anything like 2000 or 2008. Remember, 2000 really was technology stock driven, and these stocks were trading at, some of them, 1,000 PE ratio. And when things are that overvalued from a typical 16 to 18 PE ratio on the S&P, yeah, you can have a big correction. We do not see that right now. We don't see those kind of crazy valuations. In 2008, it was a credit bubble, meaning all this free credit, people borrowed money they could never afford to pay back, pushing up housing prices even higher. You're not seeing that. In fact, it's hard to get a loan today unless you really, really qualify. And if you qualify, the banks still give you a hard time. That's actually a positive, because that means people that are borrowing money can actually pay it back, or a good chance of paying it back. I like what I see. I don't see a 2016 or 2008, 2000 happening in 2016. But again, you're always going to get some volatility. Every year, the markets don't magically go up. Sometimes you have a year like last year where they were flat to down a few percent. This year could be the same thing, or who knows? We can make double-digit returns. Generally speaking, the economy is growing. Earnings should follow. If earnings grow, we should see higher equity-based prices. Chris from Naples, Florida. Where can I find safe income for retirement? Chris, I got bad news for you. You can't. There is no safe income for retirement. If you're looking for really high income, it's not going to happen. Anybody that tells you you're going to get safe high income is lying to you. You can get predictable income. It could vary in value of the asset or the income itself. But ultimately, if you're looking for something safe and guaranteed, the only place to get that's going to be in a CD, and CDs today are paying about 1% for a 1 or 2 year CD. That's it. So at the end of the day, you need to build a diverse portfolio. You ultimately need to look at this. You need to look at what your ultimate goal is. How much income do you need? What is your age? And you need to grow that income over time. And the way that I feel you can do that is called total return. And what that means is the growth of the asset you have plus the interest or dividend that it pays you, that's total return. You want an investment portfolio that can grow in value in addition to give income. Because most people that retire at 60 or 65 or 70 potentially could live another 25 or 30 years. So think about this long-term retirement. If your portfolio has no chance to grow, unless you win the lotto, which most people are not going to, you need to make sure that that portfolio grows to provide income for the future on an inflated basis. Too many investors, I believe, get too cautious sometimes. You don't want to be goofy and risky, but you don't want to be overly cautious. You don't want to be sold things like annuities, where you're stuck into these things forever, making 2%, even though the person lied to you and told you you're going to make 8% or 10% bonuses. This doesn't happen with annuities, but these guys sure will sell you on that. So at the end of the day, look at shorter term bonds, corporates, high-grade bonds, treasuries for some of the income source. Then look for part of that portfolio to be growth for total return. Then you have a good chance, in my opinion, for a successful long-term retirement. Larry from Fort Myers, Florida. Do you think it's a good time to add energy to one's 401k plan or wait for some upward movements? I'm currently 62 years old, but plan on working until age 72, God willing. Watch and listen to your show weekly. Larry, I'm glad you listened to my show. I hope you learn a lot from what we discussed. What I will tell you is this. We have been looking at oil for some time, energy or oil, let's call it oil, for some time. We currently do not own that in our portfolio, but again, our positions can change at any time. We're watching it. It's kind of in that basket on the side of investment opportunities we're watching. We may never buy it. or we might buy it a year from now or 6 months from now. What you want to do is, oil's been coming down from $100 and some a barrel down into kind of that $30, $40 range. Some people are now calling for oil to hit $20 a barrel. That potentially could happen, or it could reverse course. I don't like to give predictions. What I do like to do is look at the relative strength or weakness of that asset category. Oil's been relatively weak. There's not a lot of catalyst to push oil higher currently. We do not have a lot of demand in the world economies, meaning enough growth in order to use up the supply that's currently being created because of technology. So I would say oil will probably stay low, could potentially go lower over the short term, but I think oil at some point could be a great opportunity. I just do not think it is yet, so I would not put my money in oil at this point in time. It could go lower and you could lose a whole bunch more money. Remember, relative weakness often brings on more relative weakness or loss. Bill from Fort Myers, Florida. What direction of interest rates won't the direction of interest rates, have a devastating impact on the market? Bill, not necessarily. I'm going to go back to Jimmy Carter days. If you remember when interest rates were at 16 and 18%, when you raise rates super fast up to those levels, yes, it's going to have a devastating impact. In fact, it pushed us into a big recession. Equity markets sold off quite a bit. If interest rates are moved up very slow, which the Federal Reserve has talked about this many times, it's data dependent. If they see that the economy overall is doing well and they feel the need to slowly raise rates, and when I say slow, you might see a quarter point this quarter, you might see a quarter point next quarter, they might stop for a quarter or two. It's going to be slow. It's not going to be like back when Jimmy Carter days where rates were going up basically 1%, 1%, 1% kind of scenario. I think rates will move up very slow. Generally speaking, markets can actually do quite well when rates are rising slowly and with higher interest rates. So that's not a reason to be overly concerned. Sue from Naples, Florida. Should I hold off investing in the current market? Is it a bad time to invest in general? Should I hold off until the market stabilizes? Sue, those are all great questions. Let me hit the first one. Should you hold off in the current investment market? If it's money you don't need to spend in the next 3 to 5 years, I think by being properly diversified and properly invested, I don't think you should wait. I think too many people see turbulence and they want to wait till things get better and they're higher. The time you want to invest is when things are on sale. Again, we don't see a recession. So that means we're not raising a lot of cash. If we saw a recession, of course, my answer would be different. So what I would tell you is this. Just because things are down, when you go to the grocery store and there's a big sale, 50% off, do you like to buy more that day? Sure you do. But when it comes to investing, investors are emotional. And I know there's a lot of you out there looking at me right now having your lattes or cappuccinos or coffee this morning, and you're saying, oh, that's not me. Most investors, and I would say 99.99% of investors, are emotional. Nobody wants their money to go down even $1. They always want to see it go up. But if things are down and there's no fundamental reason for them to be down, and you're a 3 to 5 year investor, whether you're 60 or 70 or 80, you're a 3 to 5 year investor, you're not going to spend all the money tomorrow. You need to be invested and you need to invest wisely. What I would suggest is this. Call my firm for a consultation. I think you've got some concerns. You need to sit down with a qualified fee-only money manager like Rezny Wealth Management. Let's talk about your goals and objectives. Let's lay out a formal plan so this way you can make better decisions around your portfolio. Again, we do deal with larger investors, but I would suggest you call my office, schedule a consultation, and make sure you do visit our website, reznywealth.com. We've got a lot of great information available on our website for the smart investor who wants to learn a little bit more and become more comfortable. You can never get rid of emotions completely, but if we can help you keep them at bay, you have a chance, in my opinion, then, to make a return on your money instead of making emotional decisions that often make you lose money. Sam in Boca Raton, Florida. Is it time to get rid of bonds in my portfolio? I keep hearing about the risk of bonds. You know, I've talked about bonds a lot in the last year or so. Bonds, most people do not understand how bonds really work. And they often don't understand you buy bonds often for capital appreciation, not just for the interest. So let's talk about bonds a little bit, Sam. Bonds go up and down just like any investment. So don't think bonds are safe. They can go up and they can go down a lot. In fact, if you look at bonds generally speaking, a long-term bond, a bond that's 10 to 15 years in maturity, can drop about 10% in value if rates go up. So think about this. If rates go up 1 percentage point, you can lose 10% value of your bond if you sell it before maturity. If you own longer dated bonds, bonds that are probably more than 5 years right now, those are suspect to me, because I think rates will slowly move up as long as the economy stays stable. What you want to do is look at each bond you own. Some bonds you may want to keep. Other bonds may have what's called capital appreciation. Remember, as rates have come down the last decade, bond values have slowly come up. So you might have paid $50,000 for a bond, and today it's worth $57,000. You could sell that bond for capital appreciation. If you calculate the yield to maturity on that bond, it might only be 1.5% till it matures in 8 years. So you might say, hey, maybe I should sell the bond, lock in that value, that gain, and redeploy that money in another investment vehicle that maybe has a better opportunity to make a better interest or dividend for your overall portfolio. So again, bonds go up and down with interest rates. We are at a very low point of the interest rate cycle. It may make sense for a qualified firm like Rezny Wealth Management to review each one of your bonds and see if some of those should be sold or which ones should be kept. I'm not saying sell all your bonds. Generally speaking, at my firm, we have very low duration bond exposure now, usually under 5 years, and that's what I'm suggesting for most people. You need to be a little bit more defensive in bonds and a little bit safe. Folks, I'm getting close to out of time. I want you to do this. Visit ReznyWealth.com. For free, you can sign up for instant email alerts from my firm. You can also download any of our groundbreaking free reports. We try to educate investors every day. Don't be sold by Wall Street's blatant conflicts of interest. Don't be sold by the annuity salesperson at the steak dinner. Make good decisions around your money. If you're not happy with the advice you're getting, if your portfolio is not performing the way it should to meet your goals, and you're not truly happy with the advice you're receiving, call us for a consultation. We can help you. Let's sit down. You have concerns? Schedule a second opinion appointment. Let's see what we can do to help you. Take care of yourself. Don't worry about that Wall Street firm or that broker. It's time you secured your retirement. Call Rezny Wealth Management. Make sure you listen to my live radio show every Sunday, 10 a.m. to noon. Go to ReznyWealth.com, and I look forward to seeing you next week.